Hi, everyone. Welcome to today's webinar. My name is Tony Watson. Thank you so much for joining us. Today we have a great presentation for you. I myself am here representing Robert Hull & Associates, the full-service tax consulting firm based out of Glendale, California. Been around since the early 70s. So if you've heard of us, great. If you haven't heard of us, we'd love to get to know you a little bit more. And for the first 5 or 10 minutes here, I'm just going to be reviewing a couple brief points as to some key points to and some updates to the COVID-19 outbreak and the CARES Act that was recently passed over the past several months. And then after my short intro here, we're going to toss everything over to Marshall Reddick Real Estate. And they're going to talk about the wonderful world of real estate and all of the wonderful information they have to offer. I have been working with Marshall Reddick's company for quite some time. Many of them are now friends of mine and our firms. And so thank you once again for joining us. You're in for a real treat. To start off with, will the CARES Act reduce my tax liability, and how to understand a little bit about the tax implications of everything that's happened because of the COVID-19 outbreak and how it could impact, obviously, the real estate industry and all of our investments. It's a very trying time. Working in the tax industry, I've seen many ups and downs with clients, and the stay-at-home order was enacted and everybody had to start working from home. I can tell you nightmare stories. I can tell you very inspirational stories. But at the end of the day, I think we've all kind of endured the trials and tribulations of this COVID-19 outbreak together. And I think at the end of the day, it'll bring us all a little bit closer. But I've also noticed one thing about my investor clients is that they've really had, well, sadly, they've had a little bit more time to sit down and really hone in on educating themselves about some of these major changes and how it might impact them over the next year, 2 years, shoot, 3, 4, 5 years from now. Who knows how long some of the changes will trail off in the next half a decade. But I think that it's really important for us all to sit down and really educate ourselves, and most importantly, surround ourselves with professionals that are ready and able to assist with any questions that we may have. So some of the COVID-19 changes, part of the CARES Act that was passed, a lot of the questions that have been coming into our office have focused around 3 main points. The mortgage forbearance questions, some of the accelerated depreciation questions, and obviously the EIDL and the PPP plan. I'm not going to dive too much into the PPP plan today, but I do want to let you know that if you have specific questions about the PPP plan, feel free to reach out to our office with any questions that you do have. Just to talk about mortgage forbearance really quick, if you've heard of it, great. If you haven't, mortgage forbearance is actually a way to delay the payment of mortgage payments with your bank. However, make no mistake that you are not avoiding paying your mortgage, and you are not receiving any sort of relief on your mortgage payment. You are merely requesting a delay in payment for up to 180 days. Now, if 180 days is not long enough, you can actually request through your lending institution an additional 180-day extension. Most loan servicers will assist with this process. The people who you really want to talk to and request these, the extensions from and the mortgage forbearance from is with your financial institution. This is not something you do with an attorney. It's not something you do with a tax advisor. It's something that you do directly with the lender. And the interest on your loan, just to make sure that everybody understands this, because the mortgage forbearance, your mortgage is not being relieved. You're not avoiding paying the interest on your loan debt during this 180-day period, whether it's without the extension or with the extension. Your interest will still accrue over that period of time. And some of the questions: will you owe the entire unpaid amount in a lump sum once you pause the period? The pause period had ended at the loan term. Yeah, I mean, this is all stuff that you want to talk with your lender about, because I could say yes and I could say no. Some lenders have actually been pretty darn flexible with options for their clients in paying off the mortgage, not as a lump sum, but spreading it over another term with this loan. Just to be completely transparent, on Monday this week, I got a call from my bank servicer on my primary, just asking me how I was doing and making sure that I bank with US Bank, and they called me up and they asked me how I was doing, how the COVID-19, the stay-at-home order, how that was impacting me, and if I was still at work. And I felt really comfortable with that. I felt comfortable answering a lot of those questions. I thought, that's a great service that you're offering. As a tax preparer, I've been very fortunate to have continued work throughout the past 2 or 3 months, and I thank God or whoever's looking out for me that I have the ability to continue working. But I thought that was a great service that my bank was offering, and I didn't even have to reach out to them for that. And I asked the lady on the phone, hey, well, how is everybody else doing? And they said, a lot of people are seeing some pretty tough times right now, and so we just wanted to reach out and make sure that you knew that we were there for you. So, like I said, the initial contact for the mortgage forbearance questions, that should be with your lender first and foremost. So keep that in mind. With the accelerated depreciation topic, a lot of individuals who own rental properties, they didn't hear about this, and they might have heard about it recently, but the federal government actually took the depreciable lifespan of improvements, structural improvements, from the full lifespan of 27 and a half years for residential, and they cut it all the way down to 15 years, meaning that if you own a rental property and you're depreciating improvements over the lifespan of the asset of 27 and a half years, you can actually go back and change the depreciation lifespan from 27 and a half to 15 years, which increases your depreciation write-off in the current year. And that might actually free up a little bit more of your cash, because now it's reducing your liability and allowing you to pay overall less income tax on your 2019 return. One also major change for this is, let's say that you had a major loss through some investments in 2019. And I think, to be real honest with you and completely transparent, I think we're going to see a lot more of this next year because of this all happening in 2020. But if you did have losses, NOLs, net operating losses in 2018 or 2019, and you weren't able to utilize the full NOL, part of the CARES Act actually reintroduced the carryback loss benefit, where you're actually allowed to take a current year NOL and carry it back to offset prior year gains in previous year's income. So you can actually reach back, use those losses in 2018, 2017, and get money back from those years as well. So I don't want to confuse anybody too much, but I want you to understand that there are a lot of changes on the horizon, or actually that changes that are here already. The EIDL loan, a very unique loan. It allows you to qualify for up to a $10,000 fully relievable loan from the federal government. A lot of people have been applying for this. The funding actually ran out, but then the federal government re-enlisted or passed another major loan benefit. I think it's $480 billion or something like that, where they're going to have enough money to pay out a lot of these small business loans for individuals. So if you are in the process of applying for the loan, there's a lot of information that you're going to need off of your income tax returns for these loan applications. But like I said earlier, you're going to want to talk immediately with your financial institution, get the ball rolling with the loan application. And when you need information from your tax return, make sure that you reach out to your tax advisor, or if your tax advisor isn't around, you can always reach out to us, send us copies of your return, and we can relay that information back to you so you have the right information for your loan application. We are here to assist with that. So 2020 tax code, how does it affect your taxable real estate income? Remember that starting in 2018, we were able to take advantage of something called the QBI deduction, which made 20% of your business income tax-free. It's all about qualifying for this benefit. So once again, if you are having trouble navigating your tax return and you're not really sure if you qualified for this benefit in 18 or 19, but you do have self-employed income or you do have rental property income, maybe it's time for you to have a second opinion of your tax return, have one of our professionals review what has been filed in the past, and then moving forward, we can assist in 2020 with any questions that you have, whether or not you could have expensed things before the end of the year to drop yourself below a threshold to qualify for the benefit, or if you're applying for some of these loans and you need to get below a certain threshold in 2019 and what numbers to hit specifically. These are all things that we can assist with. So just keep this in mind for all of those questions. And I did want to mention that we do offer free 30-minute in-person or over the phone consultations. Well, let me dial back. Right now, we're not currently offering in-person free consultations, but as soon as the stay-at-home order is lifted, we'll be back to work status quo. So just wanted to make sure that everybody knows that we do offer free consultations. Obviously, you're not here in person to fill something out, so feel free to text RHA to 38470 whenever you can, and that'll automatically submit you for a free 30-minute phone consultation so that we once again can review previous year's tax returns and also discuss some options with the EIDL loan, the PPP loan, the mortgage forbearance questions that you may have, and also maybe some adjustments to previous year's returns to make up for the correction on the accelerated depreciation. So thanks again for joining today. I'm going to go ahead and toss the platform over to Marshall Reddick, Reddick's team. And once again, thanks so much for joining and really enjoyed today's webinar. And we look forward to talking to you soon.
Okay, thank you so much, Tony. Really looking forward to learning more on Thursday. Welcome, Marshall Reddick investors. We're so excited to have you on the webinar today. I know there is a lot of you. Had the pleasure of speaking to many of you today, and there are first-time investors, there are experienced investors on the call, but wherever you are in your real estate investment journey, I am certain that there's going to be information presented today that's going to be helpful, whether you are looking to make your first investment or whether you are looking to make your 10th investment, or whether you're just looking to learn or restructure your portfolio. For those of us new to Marshall Reddick Real Estate, a quick overview: we offer 3 primary services. First and foremost, we are a real estate brokerage, helping our clients in 16 markets across the country, not only with primary residences, but with investment property as well. In every single one of these markets, we have fully vetted, knowledgeable, and experienced teams that include lenders, realtors, property managers, home inspectors, appraisers, and every individual necessary to help facilitate a real estate transaction. We are also a property manager in our markets, helping to manage our clients' investment properties. That includes leasing your properties, preparing them for rent, collecting rent checks, you name it, making sure that your property is in good hands. And we're also a private money lender, allowing our clients both to borrow and lend their money. Just a little bit about me. I've been with Marshall Reddick Real Estate for 4 years now. I got my bachelor's in finance, and previous to working at Marshall Reddick Real Estate, my background was in construction and development. So I had experience in investing, had a background in finance, and both of those aspects of my background really fit well at Marshall Reddick. So in my past, I've helped my clients buy homes, sell homes, invest in property. I've built and sold homes myself. And so have really been able to take that background and help my clients in all 16 of the markets that we operate. A little bit about what we're going to be covering today. We have a lot to cover. First and foremost, I mentioned earlier that everyone on the webinar has their own individual investment criteria, or will have their own individual investment criteria. So how to determine what your specific criteria is and how that matters in determining what to invest in where is going to cover a large portion of our presentation today. But also conducting the proper due diligence, determining what makes a market a great market for investing as opposed to a market that we wouldn't advise investing in, because we certainly don't invest or recommend investing in just any market across the country. We're going to discuss different metrics to use in evaluating investment property. Because depending on your individual goals, different types of metrics are going to be most applicable to you. Specifically, we're going to be talking about total return on investment, more appreciation focused returns, and cash on cash returns, so specific to cash flow. Depending on your specific criteria, your specific financial situation, different financing options are going to be available to you. Conventional financing is certainly the most popular and the most common, but it's not your only option as an investor. Certainly, the best source of asset protection for all investors is insurance. So we're going to touch on insurance, and the other best source of asset protection is property management. There's a saying in real estate that you date your realtor and marry your property manager. So determining what your property manager does and what sets a good property manager apart from a bad property manager is also going to be highlighted. And then certainly we're going to take a look at different markets across the country, different properties within those markets, and why some markets are good for some investors and others for others. In working with clients at Marshall Reddick Real Estate, we follow a fairly standard process in which we start by getting to know specifically why you're looking to invest in real estate. Now, why is that important? We're all at different points in our lives. We all have different real estate portfolios. We all have different ultimate goals. So determining why you're looking to invest is going to help us determine the types of properties and returns that are going to be best for us personally. Some of us might be looking to invest so that we have money for our kids' college tuitions. Some of us may be looking to supplement our current income because we're retiring soon. Some of us might just not be happy with the returns that we're seeing in the stock market, would like to move our money around, place them in other investments. So determining what's most important to you is going to help start determining what types of properties are going to be best and in what markets are going to have the investments that best meet your criteria. Now, how is incredibly important as well. Like I said earlier, most of us are going to take advantage of conventional financing, lowest down payments, best interest rates, but not all of us can qualify for conventional financing or can utilize it depending on how we're investing. For example, if you're investing with your retirement funds, private financing will need to be utilized. And like I said earlier, we are a private money lender here at Marshall Reddick Real Estate. We're not obviously all not looking to invest tomorrow, but some of us might be. Some of us might be looking to invest in a year or 3 or 6 months down the line. So in determining the financing options you're going to use, in determining your specific down payments, determining the type of returns that you're looking for and quantifying those returns, we can ultimately decide on a type of property in a specific market that best meets your criteria. For example, a single family home in San Antonio, Texas, or a duplex in Cape Coral, Florida. You name it, depending on your personal criteria and desired returns, different properties will be more preferable to you as an investor. And once we determine exactly the type of property in the market that makes the most sense for you, we're able to get you introduced to all the team players in the real estate transaction. And I like to say that real estate is a team sport, and there are a lot of individuals, a lot of members of the team that you're going to be introduced to throughout the process. Of course, at Marshall Reddick, we have them all in place in all of our markets. Like I said, really knowledgeable, really experienced, and those team players include your regional rep or your realtor, your property manager, your lender, your home inspector, appraiser, all of them playing a very important role in adequately evaluating investment property and ultimately acquiring the property for you. Obviously, there are a wide variety of different types of properties out there. I would argue that the most important detail on this page is property class. And we're going to talk about what property class is, what it means to you. But ultimately, every property in every market across the United States falls on or has a certain class, and depending on the class of property you invest in, your experience as an investor will shift. By that I mean different levels of maintenance and vacancy, and you'll see different types of returns. But depending on your specific criteria, you may be a first-time investor and may want to start with a single-family home, get your feet wet, have one tenant. Others may be looking to put far more doors under management. So you'll be looking for 2 units or 3 units or 4 units, or 5 or more, all dependent on you as the investor and the types of returns you're looking for. Now, condition, also an important factor. Many of us are working long hours, have a career, don't want to dedicate a ton of time to our investments, as in don't want to purchase a property in poor condition and have to put a lot of work into it ourselves and a lot of time into that, because maybe we don't have that time. So you'll want a more turnkey, new, rent-ready property, whereas others, want, like we like to say, the worst property in the best neighborhood, so we can force a little bit of equity, also completely dependent on yourself as an investor. But again, this goes back to your specific criteria, your price point, the types of returns to ultimately determine what to buy and where to purchase that property. Now, to determine what to buy and where to purchase, we really want to start with these 6 questions. Now, we touched on some of these aspects already. Income versus long-term wealth. Are you retiring maybe the next 3, 4, 5 years? Are you looking to supplement your current income with rental income? If so, we may want to look in markets that are more geared towards cash flow. For example, Clarksville, Tennessee, or Cape Coral, Florida. Or maybe you are an investor who has many years till retirement, 10, 15, 20. You would simply like the best return on your money possible, regardless of where that return comes from. You may be looking for a strong appreciating market like San Antonio, Texas. The types of returns are going to be dependent on those first 2 questions and are going to open some markets to you as an investor and close others off. Experience plays a big part in determining what and where to invest in, as I certainly wouldn't recommend jumping into an apartment building for your first investment if you've never invested in real estate before, as there's a lot to learn, especially in your first investment. Certainly risk tolerance, not only in the market that you invest in, but also in the class of property that you invest. Financing is incredibly important, the type of financing that you're going to be utilizing, as that is going to affect your buying power, and depending on how much you are looking to invest and how much you are able to spend on your investment. Of course, all markets are at different price points, so that'll help us to determine what markets are available and what others might not be, and that goes right along with what you're looking to allocate to your investment. But ultimately, determining your answers to those first 6 questions, we are going to start determining what property classes we want to focus on. Now, quick overview on property class. Like I said earlier, every property in every market in the United States of America falls into a certain property class. Now, depending on where a property falls on this scale, you can expect different types of returns and a different type of investment experience. We focus on A, B, and C class properties. Now, the reason why is luxury class properties are going to be the most expensive properties in any metropolitan area. And they are going to appreciate very well, but there's going to be probably no cash flow in the luxury class market, as your mortgage will be so high, your rent's not going to be able to offset your fixed expenses, let alone your variable expenses. We also stay away from D-class properties. These are going to be the worst properties in the worst neighborhoods in any metropolitan area. The returns are going to look great on paper from cash on cash return and cash flow standpoint, but these are the properties with the highest maintenance, the most vacancy, which ultimately eat away at your returns and don't make for a great experience in owning rental property. So A, B, and C class properties, really the sweet spot. You'll find that A class properties appreciate very well, have a lot lower cash flow because they are more expensive, and C class properties cash flow well, don't appreciate quite as well as A and B class properties. When we're talking about A, B, and C class properties, none are better than the other. They're just different, and depending on the types of returns that you're looking for as an investor, we'll want to target one or a couple of these property classes specifically. Now, how exactly do we classify a property? How do we put any property in any metro within a certain property class? Well, essentially, property class is a function of the median home price in any given metropolitan area. Now, you'll see here that if you take the median home price of a metropolitan area, let's use, for example's sake, a metro with a median home price of $100,000. That would put a property priced at $100,000 in that metro right on the A-B class border. So you're going to have a great quality tenant. You're going to have a little lower maintenance and vacancy. Those properties are going to appreciate quite well. And if you're looking for appreciation specifically, then those are the property classes that we're going to want to target. Now, property class is important for a couple reasons. First and foremost, to determine the type of property, what kind of neighborhood, what kind of tenants we're going to have, but also in helping us determine, like I said, our experience with a specific investment property, so we can actually quantify our maintenance and vacancy using property class. And in just a bit, I'll show you exactly how those function into our projected returns. But also note that I had mentioned earlier in the example that I used, the metropolitan area with a median home price about $100,000, very similar to a market like Clarksville, Tennessee. Now, many of us might be tuned in from Southern California, where real estate for $100,000 doesn't exist. And if it did, it would put us way in this D-class scale, whereas where you would certainly never want to invest in, given the extreme risk of an investment like that. Whereas in other metropolitan areas in America, that $100,000 investment puts you in a great neighborhood, providing great returns with phenomenal tenants. So one of the first steps in evaluating a property in a metropolitan area needs to be determining what class of property it falls into. And those numbers you can see here are adjusted just slightly per unit for multifamily properties. This is a page taken directly from our property rating ebook. You can see here there is an interactive map. Every single one of these greenhouses represents a metropolitan statistical area in the United States of America. All of these are different markets. All of these have different median home prices. All of them have different rates of appreciation. But like I said earlier, we're in 16 markets across the country, and this is a lot more than 16. So not all of these markets are great for investing, but this is really where you start in evaluating a market and determining if it's a market that is going to have investment property that meets your criteria and has the type of investment properties that are going to help you achieve your specific goals. And I've alluded to this a little bit already on our call, but property class not only helps us determine the type of neighborhood we're investing. I'll talk about in a moment how it helps us quantify our variable expenses or maintenance and vacancy, but it also tells us a lot about the type of tenant that we have. As we move up the scale, A-class properties, you're going to have more of your professional white-collar tenants and families. You're going to have the highest rated schools. You're going to have, for example, a family that's moving into this neighborhood to stay there long term, to have their kids in those school districts. You're going to have newer homes, so ultimately less maintenance and less vacancy. Whereas as you go down the scale, you get to C class, which are more of an hourly employee, a blue collar employee. They will move a little more frequently than an A class tenant. But it's important to note, because in understanding the type of tenant that we have and in understanding the type of neighborhood that we're investing, we can allocate monthly expenses towards our variable expenses. Or I'm sorry, we can allocate our monthly income towards our variable expenses. And that's important ultimately in projecting returns for any property in any metro, because unlike fixed expenses, your taxes, your insurance, you name it, you can't necessarily, you don't know when a tenant's going to move out, and you don't know when a water heater is going to break or need to be repaired. And certainly there are a number of steps we can take as investors, and we do take throughout the process to reduce our maintenance and vacancy risk as much as possible. Ultimately, they're going to be incurred over 1, 5, 10, 15 years of owning a property. Eventually, a tenant's going to move out. Eventually, repairs are going to be done. But if we allocate a certain portion of our monthly income to these variable expenses that we don't know when they're going to happen or how much they will be, we'll be able to adjust our returns in a way that adequately compensate for those, like I said, variable expenses. And you can see here, depending on the property class, we allocate a different percentage of our monthly rental amount towards maintenance and towards vacancy, and those ultimately adjust our projected returns on any property that we're evaluating. And in just a little bit, I'll show you exactly how these percentages factor in to the pro formas on some real life investment property. These are fairly conservative. We like to underpromise, overdeliver. These numbers might be a lot higher if you've seen allocations for maintenance and vacancy than you're used to, but we found them to be incredibly accurate in depending on the property class in any given market. And you'll notice that an 8% vacancy rate is allocating about a month of vacancy for an investment property in a given year. Now, your tenant, of course, will sign a 12-month lease. Many times, regardless of property class, your tenant will renew for another year. And so that's a very conservative allocation. You'll probably experience a lot less vacancy than a month per year. But like I said, under promise, over deliver. It's a lot better to be conservative in our projections when trying to determine our future returns, so that our property outperforms our projections rather than the alternative. If you haven't read our property rating ebook, I highly encourage you to do so. Feel free to send me an email following this presentation, and I'm happy to send over the PDF and the link directly on our website. There's a wealth of information. It's a really quick and comprehensive read, but it's a really great starting point in determining what property class is most suitable for you as an investor, depending on your specific goals. and will help you classify property in any market in the United States of America. So highly recommend downloading this following this presentation and taking a read through. It also goes hand in hand with evaluating investment property on our website and helps to understand a lot of the numbers and variables that you see in our financial calculators. Now, I mentioned earlier that there are hundreds of real estate markets across the United States of America, but not all are created equal. In fact, there are many, many real estate markets across the US that I certainly would not recommend investing in real estate regardless of property class. And so you might be wondering, how do you determine what market is a great market to invest? Well, there are specific criteria in helping to evaluate any market in the US. And you can see here some very specific criteria that we utilize to evaluate a market before recommending to our investors and before putting together a team in that market. First and foremost, a strong job market, incredibly important in any metropolitan area, because job market is specifically related to vacancy rate. And so a strong job market attracts qualified tenants, and the lower the unemployment rate, the lower the vacancy rate, and the more tenants ultimately that are going to be placed in your investment in that market. And that goes hand in hand, like I said, with rental demand, point number 2. So like I said, more jobs, more tenants, more demand for rental housing. But economic diversity also incredibly important in determining whether a market is sensible for investing. Now, the most obvious example of a metropolitan area that is not, or was historically not, economically diverse would be a market such as Detroit. And we saw that when the auto industry was decimated in Detroit, what effects those had on the housing market. So we look for metropolitan areas that are not too dependent on one industry, that have multiple types of companies from different job sectors, whether that be manufacturing, whether that be hospitality, healthcare, you name it. But determining a market that is very diverse will ensure long-term sustainability of your investment property, so that if one sector of the local economy is decimated, you still have a very diverse economy with multiple different types of jobs that are ultimately employing your tenants. Housing affordability, of course, is also very important. This is specific also to California investors, of course, given where prices are today in Southern California and the Bay Area. It might not make financial sense to invest here, and it might lead us to markets outside of our own state. Now, not always, certainly depends on the property and where you're looking to invest. But it might be a reason we're on this webinar tonight and looking outside of our home state to find a market that makes the most sense, because almost certainly you can find a property significantly lower than the median home price in Los Angeles, for example, with a lot higher projected returns in markets outside of LA or the Bay Area. Now, strong education, of course, we look for metropolitan areas with strong academic institutions, as those are creating qualified tenants who are ultimately going to be entering the job market in any metro that we are evaluating. And then most important on this list, reliable property management. I can't stress the importance of property management in investing enough. Your property manager can make a great investment in a phenomenal market, a non-performing one. But there are key things to look for in a property manager that will ensure that your property is profitable, that you are keeping good tenants in there, that it is being maintained properly, and ultimately selecting the right property manager is the most important step in ensuring the long-term profitability of your investment, which is ultimately why we are investing in the first place. Here's a snapshot of the 16 markets that we are in. Now, all of these properties are, all of these markets that are pictured here hit the 16 points, or sorry, the 6 points that we had just gone over. And you'll notice that there are green boxes around several of the markets. Those indicate that these are the markets where Marshall Reddick Real Estate has our own brick and mortar offices. Every member of your team in investing in those markets is a Marshall Reddick employee. That includes your realtor, your property manager, leasing agents, and all working out of the office in those specific markets. In the rest of our markets, we still have fully vetted, experienced referral partners. So all of these markets have different median home prices, different types of returns, different types of properties. But in getting to know specifically what you are looking for in terms of returns and in learning your criteria, we can determine which of these markets are going to make the most sense for you. Here are just some quick snapshots of properties that we currently manage for our clients in several of our metropolitan areas. You'll notice that many of the properties that we manage fall within the suburbs of those major metros, and we'll talk about why in just a moment. But here we have a couple of our Texas metropolitan areas snapshotted, and real life investment properties that we manage for our clients. On the left here, we have Clarksville, Oak Grove, Tennessee, Kentucky and Tennessee, and also properties we manage in our Southern California office, our Orange County office. But you'll notice, like I said, that these properties fall within the suburban areas of these metros, and that's intentional. We help our clients invest in specifically in metropolitans and specifically within those suburban areas. Now, why a major metro? We touched on this a little earlier, but there's certainly a larger tenant base and more qualified tenants to choose from. So your investment property may have 5 or 6 applicants as opposed to just one, and it'll stay on the market for a lot shorter duration of time, ultimately reducing your vacancy rate. There's more employers in major metros, so again, attracting more qualified tenants. Also, more long-term and sustainable growth. And the more long-term growth of a major metro, the more long-term sustainability of your investment property, certainly in terms of depreciation, and certainly in terms of not just having qualified tenants today, but in 5 and in 10 and 15 years. And the most important aspect would be in being able to select from multiple professional property managers, because ultimately your property manager is going to be the individual and the organization that you are going to be in contact with for the duration of your investment. And you want to make sure that they are reputable, that they are professional, that they know what they are doing, so that your property is profitable, so that you have a great experience, and so that you're not being taken advantage of as an investor. Outside of major metros, in smaller areas where you may only have one property manager, you might run into a situation where the property manager is charging fees way above market standards. And if there's only one property manager, where do you go if they raise the fees on you? Or if they are providing a poor service and you need another property manager, you may not have another option outside of major metropolitan areas. So long-term sustainability is more ensured in a major metro, but even within a major metro, like I said earlier, we target suburban areas, specifically because suburban areas, you're going to have the best type of tenant. That's where we're most likely to attract families. Those are going to be the newest properties in the metro. They're going to have the highest rated schools, and you're within the path of growth. So what we're targeting is investment property in nicer, newer neighborhoods, nicer schools. Of course, newer homes have less maintenance. Neighborhoods in better schools within the path of growth will have less vacancy, and those factors directly impact your returns and your experience as an investor. The next several slides just reference several articles directly pertaining to the 6 points within the major metros that we're in, and ultimately reference the research that we've done in selecting these markets as ideal investment markets for our investors. Now you'll see there on the left-hand side how diverse San Antonio's economy is. And you'll notice that the largest sector of San Antonio's economy is 18%, and that's in management occupations. And you'll notice how many different industries exist in San Antonio. So ideally, a great metro to invest you'll see as many slices and different colors on that pie as possible. That goes back to what we said earlier, so that the economy is not too dependent on one industry, essentially. But for every market that we're in, we have market data packets that highlight the key aspects of the local economy and housing and job markets. They're all available on our website, so you can get to know more about metros that you may not have heard of before, or you would like to learn more about. And for any market that you're interested in, the URL is right there at the bottom of your screen. I'm also more than happy to send over the PDFs and the links on our website, and they will go over those 6 points that we had touched on earlier for every market that we're in. Now, in the process of working with investors at Marshall Reddick Real Estate, we're certainly going to have to determine how we're investing. We touched on it a little earlier. Majority of us are going to utilize conventional financing. In conventional financing, we are taking advantage of the best interest rates, the lowest down payments, especially today with interest rates as low as they are. If you can utilize conventional financing and you are planning on financing, then we certainly want to pursue that option. But some of us might be investing with our self-directed retirement accounts, in which case we'll need to utilize private financing. We have those options available. Some of us might be looking for a cash purchase, in which case financing is not going to be necessary, of course. Some of us may have a lot of equity in investment properties that we had invested in years ago and want to utilize a 1031 exchange. So we want to know how much equity we are exchanging and what our purchasing power is going to be based on that 1031 exchange. So again, depending on your short and long-term goals, depending on your current portfolio and those aspects relevant to you as an investor, we'll determine specifically how we're going to allocate our resources to our next investment. Quick snapshot of our preferred lender at CMG Mortgage, Reed Hazard. We have been working with Reed for 15 years. He is a seasoned investor himself. He's licensed in all of our markets. He has a great team behind him, and he really understands investment financing. And I can't stress how important it is to have a solid, knowledgeable lender on your team when you're looking to acquire investment property. And so I can't stress the importance of Reed on our team enough. Reed's information is right there on your bottom left-hand side. He's one of the first people that we get you introduced to here at Marshall Reddick Real Estate to learn your borrowing power and to learn what type of financing you're eligible for. All right, now we're getting to the good stuff, the metrics. Cash flow versus appreciation. Two most common metrics used in evaluating investment finance or investment properties. And depending on what you are looking for as an investor, both of these are going to be important, but one's going to be more important than the other, whether you're looking for passive income or long-term return on investment. Here's a snapshot of the appreciation rate in the Clarksville metropolitan area. There's a couple takeaways here that I'd like you all to notice. First and foremost, you'll see that their appreciation trend is, for all intents and purposes, very linear. There is obviously some variability, but not like the variability we see in other metros like Southern California or in markets in Florida. It's a very steady market. So this is a market that I might recommend to an investor that is risk averse. And you'll also notice the median home price, $158,000. Now that is significantly lower than metros that have median home prices of $700,000, $750,000 or more. So an A-class property in Clarksville falls right at that price point, $158,000. And also historically, appreciation has been steady with very low variability. You'll see that if you take a look at 2008, the appreciation rate was zero. So in Clarksville, there wasn't even a decrease in home values. They just stayed the same, essentially. And many of the markets, in addition to Clarksville, that we help our clients invest, have similar patterns in terms of variability in their appreciation. But regardless of what market you're looking to invest in, this is data pulled from the National Association of Realtors. We have this data available for all 16 of our markets for you to take a look at. It's the historical data, so you can see, of course, what that average appreciation trend is. That's data that we utilize in our financial projections to determine the median appreciation and project future appreciation. So here is an example taken from our website of an investment property in Oak Grove, Kentucky, bedroom community in the Clarksville, Tennessee metropolitan area. Now, going over the pro forma, you'll see that the first box assumes conventional financing. You'll notice that there's a down payment of 25%. 20% is the minimum that you can put down if you utilize conventional financing. 25% will get you a little better interest rate. And we also factor in some closing costs to show you exactly how much you'll be investing from your own pocket in this specific property. Now, investment capital needed is a really important number to note because both cash on cash return and annual return on investment factor in your investment capital in future projected returns. Second box, you'll notice, first and foremost, your gross rent. The gross rent for any property on our website is determined by our property managers who do a rental analysis. They use the middle of the line rental average based on comparables in the neighborhood. And then from your gross rent, we subtract all of your fixed expenses, those expenses that we know that we're going to incur on a monthly basis. So for this property specifically, with a gross rent of $1,095 a month, we have fixed monthly expenses of $656 a month, leaving us with monthly income of $438.71 a month. Now, I had mentioned earlier how classifying a property helps us determine and allocate certain percentages of our gross rent to maintenance and vacancy, which is important because ultimately those expenses are going to come up in owning investment property, but we don't know exactly how much those are going to be and when they're going to be incurred. So you'll notice there's two numbers here. A lot of people mistakenly call this $438.71 a month their cash flow, but that ignores your maintenance and vacancy that you're going to incur in owning this investment property. But we know, based on the price point and the median home price in Clarksville, Tennessee, that this is a B-class investment property in a B-class neighborhood with B-class tenants. So we allocate 10% of our rent to maintenance and 10% of our rent to vacancy to adjust our monthly income for an adjusted monthly cash flow of $189.30 a month. Now, that's incredibly conservative given the higher allocations for maintenance and vacancy, but it adequately accounts for that maintenance and vacancy that you will ultimately incur. And in just a moment, I'm going to show you how to use that number to determine how much of your return you're seeing on an annual basis just in cash flow, called your cash on cash return. But just quickly, I'll note that these pro formas also point out your 15-year projected profit. Now that will include your principal pay down and your appreciation in a market, and your 15-year annual ROI. So your annual return on investment for, we default to a 15-year holding period. So quickly here, this is the function for cash on cash return. Essentially, what this number is going to show you is how much of your total cash invested. So remember that figure that we talked about earlier, your out-of-pocket expense for investing with conventional financing, how much of that number you are seeing back in tangible cash every year after your maintenance and vacancy expenses. So this $2,271.57 is simply this adjusted monthly cash flow figure multiplied by 12, divided by your initial investment. You have a projected cash on cash return after adjusting for maintenance and vacancy of 6.53%. Now, this metric is incredibly important for those of us who are looking for passive income specifically. Clarksville is a great market for passive income and cash flow. So if you are an investor looking for passive income, cash on cash return is going to be the best metric for you. You're going to want the cash on cash return to be as high as possible. And I would say that for a property after maintenance and vacancy factored in, to have a cash on cash return of 6.53% in a B-class neighborhood is an incredibly sound and strong investment. You can also see best case scenario. Like I said, a lot of investors will confuse that for their actual cash flow. You can see if you utilize that number in the cash on cash return investment, your cash on cash return is over 15%, which again, this is going to be best case scenario, what you'll be seeing on most months until you ultimately incur some maintenance and some vacancy. And here's a snapshot on our website. Again, every property on our website has its own unique adjustable financial calculators. So You can adjust the numbers. If you don't agree with ours, you can see worst case scenario, best case scenario. And one of my favorite things to do with investors is go through the calculator line by line. So any questions following this presentation that you may have about the financial calculators or otherwise, more than available to help. Another one of our most popular investment markets for our clients. Now, you can see some fairly key differences between a market like San Antonio and Clarksville. Higher median home price, but also higher average appreciation. So for those clients of mine who are looking for the highest return on investment possible, doesn't matter how much of that is coming from cash flow or tangible cash, just as high a return, whether that be from appreciation or principal pay down and cash flow as possible, because their cash on cash return doesn't necessarily matter right now. I would recommend a market like San Antonio, Texas. And here we have an example taken directly from our website. Again, this is a newer A-class duplex in the San Antonio metro. You'll notice this is specifically A-class, but now I'm going to show you guys exactly how to calculate the return on investment. So not just your return from your cash flow, but your return from your cash flow and the appreciation and principal pay down of holding your property for, in this case, a 15-year holding period. So here you'll see annual return on investment, again, takes into account our initial investment capital. In this case, for this duplex in San Antonio, our initial investment capital is just over $105,000. And to determine our annual ROI of 18.01%, we take the profit from our sale, which can be determined by taking our purchase price, adding in our total appreciation. In this case, we have appreciation over 15 years of 3.88%. Remember, that's taken from data from the National Association of Realtors, the appreciation trend I showed you just a couple slides ago. And we see over 15 years, this property has appreciated about $242,480. Now, I'd also like to point out that you see a far greater return for this property specifically from appreciation and paying down the principal on this property than you might see in cash flow. So a lot of your return is not coming from tangible cash. It's coming from your property gaining value and coming from your tenants paying their rent every month and you paying your mortgage. So you're paying down the principal and ultimately building equity in your property that way. But that's ultimately how we determine this number, total projected profit of $284,477. We take the total cash flow adjusted after maintenance and vacancy, plus 15 years of appreciation at 3.88%, plus 15 years of paying down your mortgage on a 30-year fixed mortgage, adding those numbers up, and subtracting your selling expenses. Remember, when you go to sell a property, there are closing costs and realtor commissions to factor in. So to be conservative and accurate, those are also factored into your total projected profit after 15 years. And taking that total projected profit, the $284,477.22, and dividing that by our initial investment capital, divided by 15 to give us an annual percentage, we see that for this property, conservatively, based on our initial investment of $105,000, we are seeing a return of just over 18% throughout all the ways we make money in real estate. Again, appreciation, cash flow, and principal pay down. Here's a snapshot of the blank property financial calculator on our website. Again, I really enjoy going through this line by line with my clients to make sure they're able to utilize this and essentially be able to evaluate any property that they're interested in. Happy to send you the link to this as well. Simply let me know as I follow up with you, give you a call or through email as well that you'd like it, and I'm more than happy, like I said, to get it over to you. And now I'd like to introduce Scott Pastel.
This is Scott Pastel speaking right now. I'm the VP of Real Estate and Property Management for Marshall Reddick. With Marshall Reddick, I started working here February 2005, so it's been quite a long journey. And I've been blessed with the ability to purchase several rental properties since working here. I started buying my first rental property in 2008 and several more since in different states across the country. I still own all my rental properties. And as I'm going to talk about more in my part here, how important that property management is. Property management is the make or break factor in real estate investing. And Marshall Reddick Real Estate provides property management in all the markets we're located in. We do so with very fair fees. We start at 7% and it goes down in monthly fees the larger and more units that property has. So our really main two fees are our one-time leasing fee at half of 1 month's rent, the $500 minimum and a $2,500 maximum. If we ever collect any late fees, we split those in half with the owner. We charge the most aggressive late fees that whatever state we're in allows us to. So I want to kind of just cover, what a property manager does. Now, when most people think of property management, they think of a guy coming to the property, measuring tape, hammer, Joe the plumber. I think it's kind of gotten a reputation, I feel like, over time that a property manager's job is just to collect rent and do maintenance, and it is way more than just that. What you need to realize as a property manager is your buffer of liability. So they significantly reduce your liability. They understand all of the state laws, the fair housing laws. They do this professionally. They know what addendums and disclosures need to be in the lease. They know how much advance notice to give to a tenant before they enter. It's safe to say they're not winging it like most landlords are who are trying to do this on their own. Too much risk involved, too much money involved. Use a property manager even if your property is next door to you. And a lot of us are very busy, have families, full-time jobs, so there's just doesn't make any sense in my opinion. There's no benefit whatsoever to not using a professional property manager. When you're looking at a property management relationship, the only relationship that works is if the property manager is only making money when the landlord's making money and isn't making money when the landlord's losing money. And what I mean by that is there are companies that charge management fees during vacancy, which we believe highly against. That's not really for the benefit of the owner at all. And there are property management companies that generate a lot of money from the maintenance and repairs. This is all about scaling a rental property portfolio here, a passive portfolio. No one gets rich off 1 or 2 properties. This is something that will probably take a 5 to 10 year investment process, looking at probably 5 to 10 properties over a 5 to 10 year period. In order to achieve financial independence, we're probably going to need to do this a handful of times on a handful of properties. So it just doesn't make sense to try to do on your own. You really want a team that can do all this for you, allow you to focus on your work, your family, your hobbies. So just to hit on a couple points here, what is a good property manager? Well, they're at the very top. In this day and age, in 2020, if a property manager doesn't have a modern website with a login for their tenants and owners and properties for rent on their website, I would question their ability to manage a business. I'd question their ability to manage their tenants. It's extremely important to have very good software for a property manager. Now, we manage right now just under 700 properties. We utilize our software very heavily. It stores all the property details, lease details, tenant details, landlord details. So, if the front end website looks bad, most likely their back end management software does too. So now going clockwise, is there a maintenance conflict of interest? This is a question that you need to be aware of anytime you're working with a property manager, that your property manager is only making money when you're making money and not making money when you're losing money. Cost versus service. There's an old saying in property management. Well, there's really an old saying in I think in life in general that you get what you pay for. That could not hold more true than in property management. Average property management fees across the country usually range from about I'd say 7 to 10%. I've seen it a little lower, 5 or 6% here in California in high rental markets. Again, what I've noticed is that companies that charge unusually low fees are usually making up for it, the difference in repairs and maintenance. So our management fee is 7%. We only charge that when we collect rent. You need to understand how responsive your property manager is. I mean, you know, if you're not able to get a hold of your property manager, then neither are your tenants, right? And if you're getting good responsiveness from us, so are the tenants. It translates on both sides. It's extremely important that you have a property manager who can get back to you quickly, answers the phone, calls you back, responds to emails. Again, you know, I look at property management kind of like having a babysitter. While we're at work, while we're traveling, our property managers are our babysitters taking care of our properties and our tenants. So it's very important that we're able to get a hold of them when needed. Online reviews, you can look on Yelp to see a property manager's ratings and reviews. You can look on their Google business page. We happily encourage people to read our reviews. I think combined, we have over 400 reviews across Google, Yelp, Zillow, a lot of them written by landlords and tenants. So I think it's very important to see what tenants and landlords are saying about a property management company. And lastly, it's good to know if there's a cancellation policy. If you're ever unhappy with your property manager, are they going to charge you for fees? All right, very final couple minutes here. I want to end with going over all of the major, I guess you could say the main risks in real estate investing. And talked about vacancy and maintenance. There's also the potential of property values going down, natural disasters, liability for the owner. These are all things that we want to reduce as much as possible. And really, I would have to say, one of the things that I love about real estate investing is that I can clearly articulate to you guys right now in a matter of a minute or two exactly how to reduce each one of those risks as much as possible. We talked about property classes and our property rating ebook. Higher property classes tend to have lower amounts of vacancy. That's one way. Another way is buying within a major metropolitan market that has a large diversity of employment, 500,000, 1 million, 2 million people living there, lots of job growth, a business-friendly market. You know, when you're inside of a metropolitan market, you have a much larger rental pool than you would in a small town 2 hours outside of that metropolitan that only has, you know, 10,000 people living there. It's one of the many reasons why we stick to major metropolitan markets, larger tenant pool and a larger pool of potential buyers if we sell that property in the future. Then on maintenance, well, when you're buying a property, you should be doing a home inspection. And if you're using Marshall Reddick to purchase that property, we're going to encourage you to hire a home inspector, a licensed building inspector to walk that property. And they're going to provide you with a detailed report. It's kind of like a Carfax when you're purchasing a car. Home inspections can be 50, 60, 70 pages. And a home inspector is going to look at everything, test every electrical outlet. They're going to look at the age and condition of all the appliances. They're going to look at the electrical wiring. I mean, they're going to tear that property apart and find things that none of us would be able to find. So what's great about that home inspection is that it's a negotiating tool for your realtor, the buyer's agent, to negotiate for a credit or repairs that are needed on that home inspection. Now, if you continue forward and end up purchasing that property, you now have a much better idea, first of all, the age and the condition of all the major things like the roof, the AC unit, the water heater, the garage door. That gives you a much better idea of the condition of those items and also can kind of give you a view into the future of when it might be time to replace them. So you have a better idea of the potential deferred maintenance down the road. Now, we're going to get that home inspection. We're going to pass it over to our property management team, and they're going to be aware of what those potential deferred maintenance items may be in the future, and they'll encourage you, if needed, to take care of that before we rent it. Mentioned higher property classes have lower amounts of maintenance, and then of course brand new construction properties or turnkey, meaning the seller did all the updates to all the cosmetics. Those properties tend to have less amounts of maintenance than others. Property values going down. Now the key here is if we're able to put 20 to 30% down on a 30-year fixed interest rate loan, get positive cash flow, and you'll do that by choosing properties that we select because we look for those types of properties. Now, if you're able to put 20 to 30% down and get positive cash flow, you can hold that property for long enough for the foreseeable future until the property values come back to a point where you may want to sell it in the future. Again, one of the reasons why we're in these major metropolitan markets is because there's such strong rental demand. There's job growth. You know, these are locations that that have very low vacancy rates. So if we even get into a economic downturn close to what we saw 12 years ago, what we saw back then were millions of homeowners who had to become renters. So the rental market significantly increased in the subprime meltdown 10 to 12 years ago. Safe to say, you know, people need to live somewhere. And the safest market to invest in is the rental market, because no matter what happens to financing, lending, economy, people need to live somewhere. Lastly, things like natural disasters, insurance claims, liability, medical bills. If we ever have to get into a legal claim with our tenants, again, the property manager, we are going to significantly reduce those chances. But your liability coverage in your landlord insurance policy is there to protect you. So look at your deductible. I would say probably not to go for the highest one, maybe $2,500. Make sure you have the ultimate liability coverage would be having about $500,000 of liability coverage per property. You can even get $1 million umbrella policy to blanket all your rental properties and your primary residence. So your insurance and your property management is your formula for asset protection. And if you follow all the things on this screen right here, then this is exactly what you should look like when you purchase a property with Marshall Reddick. And that was me. This was actually right after I closed escrow on it in Phoenix, Arizona. I purchased almost 10 years ago now. I've had the same tenant there. They're about to renew their lease next month. So hopefully, as far as I know, it'll be their 5th year. This is the type of property that we look for, a newer property, a property that will attract a family, a long-term renter. So at Marshall Reddick, we practice what we preach. So it's something that we truly, truly believe in.
All right, Scott, thank you so much. And really want to thank everyone for joining us today. Hope it was informative, educational, really gives you a great idea of where to go next, and asking that question, what is next? Would love to hop on a call with each and every one of you and go through the process, get to know what interests you in attending this webinar, where you are in your investment journey, the types of returns that you're looking for, and start the conversation to ultimately determine the best properties in the best markets to provide the returns that you're looking for, both short-term and long-term. And again, in working with you to get you introduced to all of the very important members of your team in investing in real estate, a snapshot that you see there of just 6 of them. Highly encourage everyone on the webinar tonight to take a look at our Learn tab. This is an encyclopedia of real estate. This is all free. This is all incredibly informative. Our mentorship and education here at Marshall Reddick Real Estate is free because we believe that your hard-earned money should be allocated towards your investment properties. And again, there's an incredible amount of resources to help you get started. And the URL, again, can be found right there towards the bottom of your screen. All of my information can be found here in the bottom right-hand corner, including my phone number and email. Feel free to call, email, text. Again, would love to set up a time and start the conversation with each and every one of you. And thank you so much for, again, joining us today. Hope you found it informative and hope you all have a great rest of your day.
Thank you very much, everybody.